All right, guys, welcome to the strategy session for January 24th. Hope you all had a great weekend and a great week last week as well. Lots of fireworks on names like BlackBerry, GameStop, Palantir on Friday. A lot of volatility. This week won't be any different at all because we do have earnings coming up. So just a fast review on what's happening right now in the market for the coming week. For economic data points, the primary one to look at this week will be on Wednesday, 2 p.m. FOMC meeting announcement, right? And then Jerome Powell will be speaking at 2:30. So circle that on your calendars as that should be a bit of a market mover. Obviously, jobless claims are on Thursday, GDP on Thursday as well, new home sales, Friday, personal income, consumer spending, yada, yada. It hasn't really mattered so much yet. Core inflation should be interesting to look at as well. Keep an eye on that. And then for earnings this week, we have a bunch of earnings for big names. So we have XLNX on Monday after close. We have on Tuesday, J&J, GE, 3M, Innovation, Lockheed Martin, Verizon, American Express, Raytheon before open on Tuesday. After close, we have AMD, Microsoft, Starbucks, Texas Instruments. What else here? Wednesday before open, Boeing, AT&T, Abbott Labs, Blackstone. After hours, you have Apple, Tesla, Facebook. So Wednesday, circle that. Big ones are going to be Apple, Tesla, Facebook, Microsoft, AMD, Starbucks as well. And then you also have on Thursday before market open, McDonald's, Mastercard, Sherwin-Williams. I mentioned a few weeks ago, they should be doing pretty well because everyone's spending time and money renovating their homes right now. So they sell paint for your house, right? So keep an eye on Sherwin-Williams as well. LUV, obviously they should be doing that well right now amidst a pandemic. After close on Thursday, you have Visa, Skyworks, Atlassian, which is ticker symbol work, I believe. Or no, it's team, sorry, it's TEAM, yeah. And then you have Western Digital, MicroStrategy, which is a large holder of Bitcoin. They report on Thursday after hours, so keep an eye on that. And then Friday before market open, you have Caterpillar, Eli Lilly as well, SAP, Chevron, and I guess Honeywell too, right? So a lot of big names reporting this week. You should see a lot of volatility in certain sectors, namely the tech sector, right? Obviously, we're seeing Apple push all-time highs as of Friday. Microsoft is near all-time highs as well right now. AMD kind of stagnated a little bit off of that 100 mark and pulled back, but it had a little pop on Friday amidst another, mediocre report from Intel. Looking at the expected moves this week, here we go. You can see, so for Apple, we have an expected move of 6% this coming week. And keep in mind, they report earnings. So anyone with the ticker in bold here is reporting earnings. So you have I'm going to pull up the actual option, the actual chart on Apple so you can see Apple's chart. Here it is. One second. Let me just share it with you guys. New share. Here we go. So for the week ahead, the upper expected move for the week ahead is 147.45. So, well above all-time highs, obviously. And the lower expected move for the week ahead is 130.69. So right over here where it opened last week. The potential move is 8.2%. So it could go as high as $150 and change and as low as 127.59. Now with Apple, I am very bullish on them because they are basically becoming both a subscription behemoth and a product behemoth as well, right? So they have, iCloud, Apple Music, Apple TV Plus, they have Apple News, they have Apple Fitness now, right? So you have a bunch of different subscriptions that everyone's paying for, myself included, every month. And that adds up a lot, right? Because it provides recurring revenue. So they're killing it on that front. They also released the AirPods Maxes back in December, and they sold out promptly for a few months. That product was priced at a low-end iPhone, so keep that in mind as well. I'm assuming the margins there are going to be much higher than that of an iPhone. So that's probably going to be a nice boon for their earnings as well and revenues. And then additionally, the iPhone sales for the Pro and Pro Max were very robust, right? The iPhone, the lowest end one didn't do very well apparently, but the higher end ones did very well. So I am very bullish on Apple. That being said, One of my personal rules is not to trade earnings outright. So if I have a position that's already existing, you know, if I own stock or I own leaps, for example, or I own calls a few months out, I'll hang on to it. Obviously, I may hedge a small portion of that position using perhaps a 4 months covered call, for example, on a leap. But otherwise, the best way to play earnings typically is to wait till after the event. And even if it moves big, it doesn't really matter because the IV crush is so massive. And then you have the ability to trade with all the information in hand, right? So you know what the revenues were, EPS were, guidance, all that stuff, right? Any kind of commentary, any kind of buybacks, for example, all that information is factored in. If you're buying prior earnings, it's very, very binary in nature. And you are sort of gambling, especially if you're buying short-term expiration date contracts. If you're buying same week expiration, especially out of the money, it's super binary, right? You're pretty much going to lose everything, or you may make a great return, right? But it's very binary in that regard. So keep that in mind if you are going to place those kind of bets. Next up would be AMD, right? So AMD over here. So we can see that AMD has been bursting above consolidation levels repeatedly this past year. So it was in that nice little range between 50 and 60 or so for a few months. Then it broke up on that terrible Intel report back in July rather. And then it hovered in this range between 75 and 85 for a few months. And now it's broken up to a new range between around 85 and 100 or so, right? So they report this coming week. The expected move is 8.4%. Upside is 100.62. And downside is 84.96. So again, downside is right where the support is. Upside is right where the resistance is, right? So pretty easy to follow this one right here. If you're trading it again, IV is elevated and you will want to use spreads. Again, I don't advocate trading earnings. I prefer to trade after the earning event because I find that the opportunities are much better. You're paying much lower premiums after the event. And if you get a very, very muted response, like for example, let's say you get a phenomenal report and a downward move after earnings, that to me is a great buying opportunity because now you can buy a great report at a discounted price, right? You're paying low IV premiums because IV is inflated already, and you're buying on a downside move. Case in point was actually PayPal, and I think they report next week, I believe. But here's PayPal right here. You can see they reported, I believe it was over here. Yeah, so they reported back over here on November the 2nd, right? They fell down to a low of 175 roughly the following day. And you can see right after, so they reported on this day over here after hours. Next day, they fell down over to here and they punched up about 16% in roughly 2 days after that report. So if you had bought the dip after the report, on a good report, they beat EPS and beat revenues as well, and guidance was strong. You could have caught a nice big move to the upside right there in cash. And I actually caught that move right there myself. But as you can see, the aftermath of that move was a nice big push from around 170-ish to now it's 252. It's up about 45% in the last 3 months. So that's how you want to play earnings typically if you want to manage your risk well. Obviously, if you want to gamble, I can't stop you, but that's your choice. Just make sure to manage your risk and don't put in more than you can afford to lose, right? Keep that in mind too. Next up is Boeing, so BA, right? For the week ahead, they report earnings. I believe it's on Wednesday morning, if I'm not mistaken. And they have an expected move of 4.6%. Upside is 215.39. Downside is 196.29. And the potential move is $13.94 or 6.8%. Upside is around 220. Downside is around 192. So 192 area is right over here roughly. Sorry, a little bit higher than that. And the upside is 220-ish, so right over here roughly, right? So pretty tight little range right there. And Boeing has been obviously consolidating. They consolidated in period over here for a little bit. And then they broke up to the upside over here to a new range, came back down a little bit. But they've been in a pretty tight range for the past what, basically since June, right? So since June, they've been between like 150 downside to 25 upside. But for the most part, they've been between 175 and 150. So pretty tight range over here. And they broke up to the upside over here, obviously. Now they're in a new range right now. But if they do have a decent report, which I don't anticipate they will, but if they do, then you'll see it probably push to around 230-ish and perhaps create a new trend between 200 and perhaps 250 over the next few months, right? That's the next one that I was talking about. Next one is Microsoft. MSFT, right? They report on Tuesday after close, right? And they have an expected move this week of 3.9%. So the upside this week is 234.73, which would mark fresh all-time highs. The downside is 217.17. And the potential move this week is 5.1%, or upside of 237.56, downside of 214 roughly. So again, in this little range between pretty much right here, or sorry, right here roughly, and right about over here. Again, this has marked a long period of consolidation in this pretty tight range between 220-ish and 200 or so. I do expect you're going to see a pop-up, kind of like you saw a move over here, you know, a pop-up to new all-time highs, and then establishment of a new range. So I think the new range could use the previous resistance areas as support. So right around, like, you know, for example, 227 area support perhaps, and you might see resistance around like 240 perhaps, right, at 245. So that would be the new range I'd expect. I think they're doing phenomenally well under Nadella as CEO, and I don't think anything's going to change there. I think Apple, Microsoft, and Salesforce are the three horsemen of tech that will be just unstoppable pretty much forever, right? Next up is Mastercard, right? They report this week as well. You can see, again, same establishment of a tight range here between around 320 and upside of around 350-ish, right? And for this week, they have an expected move of 3.7%. Upside is 341, so right around here. Downside is 316.81, so down over here roughly, below the support area. Obviously, if they break support, they'll probably flush down. It could flush down as low as 290 area, which is also heavy support over here. And then you have a potential move of 5.1%, so upside of 237.56. So right over here roughly again, near 340 roughly, and downside of 214.34. So right over here roughly, right? I don't really focus on MasterCard at all, but one of their competitors, Visa, reports also this week. They report, I believe it's on Thursday after close, and they have an expected move of 3.5% in one direction. They've actually been in a pretty tight range as well. You can see a lot of consolidation here in some of these names, right? So Visa's been trading between roughly 200 and 210-ish or 215-ish for the past few months, and they've been trading here for a while. Previous highs before the market crash was around 214.17. So what you want to see is a push up to the upside, and no longer a rejection around 215 again, because you want to see push to new all-time highs around 220 area, and then that creates a new support area perhaps, right, on heavy volume. So the upside this week would be 209.17. Downside is 194.87. And then the potential move this week is 4.6%. Upside 211.41. Downside 192.63. These are pretty fun to play with butterflies, actually. I used to play them with butterflies because they don't move a lot on earnings. So let me just pull up the option chain and show you guys what I mean by that for a sec. Where's Visa? 1 second. So here's the option chain on Visa. So trading, again, I don't like going on weekly OPEX, but if you want to trade the same week expiration, you can, obviously, that's your choice. But there are interesting asymmetries of risk. So for example, if you were to do a 210 long, 215 short, 220 long right there, you're selling two of the middle strike for a butterfly. You can see that your risk here is about roughly 34 cents, or sorry, 33 cents midpoint roughly, right? Maybe even 32 cents. And your maximum profit would be 5 less 32 or so. So your maximum profit would be $4.68, for example, right? But keep in mind on butterflies, you'll pretty much never ever hit max profit, because that requires that the stock price closes on the nose at 215, for example, on Friday at 4 p.m., which is a very, very rare occurrence, right? So the target would be obviously to get into a butterfly, for example, and cash out perhaps half your position at a double up and then ride the rest for free, essentially, right? That's the whole idea behind it in my books. Just a little thought right there. Obviously, it has to move to the upside area of 210 to be in the money. Break even is 210 plus 33 cents or so. So it's 210.33. But that would be an interesting way to play it with very, very small amount of risk, right? If you want to go longer term, obviously Visa is a very strong company. And if you want to own it at a cheaper price, you can always sell cash secure puts out of the money, for example, Not a lot of premium here, but if, for example, you're selling the 170 strike, a couple months out, you're probably gonna get a pretty significant IV crush after earnings. It'll probably elevate to around 30% or so, and then come down to about 10% after earnings. So if you're to sell these right before ER, you might get $1.20, $1.30 for them, and then you need to be okay owning the stock at 170 less $1.30, so 168.70 roughly, right? And then obviously for those of you that aren't aware, selling a cash secured put, you want to have the cash in your account equivalent to 100 shares at the strike price. So for example, if you're selling a cash secured put here, you need to have 17 grand in cash in your account ready to buy the stock for 100 shares at 170. And obviously you're going to put that premium in your pocket, right? So that cash should be pretty much tied up for roughly 2 months. So keep that in mind as well, right? Just a more strategic way of trading Visa if you want to own it longer term at a much cheaper price. Obviously, if you want to own it below 200, you can still have the money if you wanted to and pull in a lot more premium, but it's more risky because the probability of being assigned is much higher. If you want to be assigned, then by all means, right?
Let me add something on CSPs.
Yeah, go for it.
When you're doing a cash secure put and you're close to the money or in the money, right? It gets harder to roll. So if you're not happy with something and you want to move it, you want to try to get it so that you move prior to it actually hitting. So what's Visa at 202? Let's say you sold the 210s, right? You sold the 200 puts, sorry, right? If it gets to 201, even though it might work itself out, you want to move at that point because when you get to the strike or past the strike, you can roll it, but they're going to ask you for more time and they're going to pay you less to give you that option. Whereas if you jump the gun just slightly, okay, you're often able to go just out 1 week and move it down to, let's say, 195 on a CSP. The other thing is a lot of you guys are going to notice that, well, they didn't take all the cash. They only took 25%. They only took 30%. No problem. No big deal. It's not going to go past, 30%, right? And I've got 30% covered. The problem is when the shit hits the fan, it usually doesn't hit the fan on one position. It hits the fan on multiple positions. So what will happen is they will give you a margin call or they will change the level of margins. They did this on Tesla a while back. Tesla margin was 20%, then they changed it to like 60%, right? Something ridiculous. And you have no say. And at that point, if you don't have the cash, they can liquidate any part of your account to cover it, technically. They technically will liquidate that thing, but that doesn't mean that, they have to. They can do whatever they want. You're really putting up your whole account for that. So always keep in mind that you should have the full amount of cash, or you can get the full amount of cash within 24 hours wired into your account. This is very, very important when you're doing spreads, right? Because when you sell a spread, you're like, oh, okay, I've only got this much difference. But what if they exercise one side? Now you have a long side, but they exercise the short side, and now you're negative the stock, right? It's very simple. Just exercise your other side, worst case scenario, or buy it back and sell that, right? That's not a difficult thing. But when you see it for the first time, I promise you, you will be shitting a brick because your account will look really, really messed up. So just when you're doing CSPs, when you're doing CSPSs, right? Always keep a good tally of how much cash you need to have on account. Don't get caught short. Yep, that's just my 2 cents.
Well said, Ashish. Really appreciate the insight. Yeah, that's a very valuable lesson, guys. Don't overextend your margin, and always be aware of how much cash you have allocated per position, especially when you're selling cash secured puts. And that's important because obviously the market were to crash, like it did it back in February and March. Last thing you want to do is get a margin call and get forced liquidated out of all your positions, and pretty much it has the potential of actually bankrupting you if you do take too much risk on, right? Because you would actually not only owe what you have in your account, but you're obligated to pay anything that is owed under the agreement that you sign when you open a brokerage for margin, right? So if, for example, you sold 50 contracts of Visa or something like that, which would cost you, let's say you did it at the 200 strike, for example, that would be $1 million in capital required. And basically, if it were to go to, let's say, $100 overnight for whatever reason, right? Then you'd be down 500K. And let's say you didn't have 500K in your account, they can go after your house and everything else, for example. So just key lesson to learn is not overextend yourself. You want to always, again, allocate no more than, depending on your portfolio size, I always say between 1%, 5% of your portfolio maximum to any given position, because again, no matter what we do in the market, the one thing we always know is that we don't know for certain what's going to happen. So people that say, I know for certain so-and-so is going to happen, they're full of crap, right? No one knows what's going to happen. We trade the probabilities, right? So we trade probabilistically and figure out, okay, you know what? I don't mind owning Visa, for example, at 170. So if I'm owning Visa at 170, I'm owning it down over here, for example, right? I don't care if I own it over here because I'm pretty much buying it, only about $35 away from the lows back in March, right? For it to go down to here, that's a fall from here down to here. That's a fall about, 16% or so, right? And I'd be okay with owning it over there, for example, if I was selling a cash secured put. But that doesn't mean you're going to go and sell, 100 cash secured puts because they're $1 each. You sell one contract or two contracts, assuming that you're okay with owning the stock at that price, right? And that amount of stock as well. So that's why don't get too gung-ho and think about collecting all that premium, because again, all it takes is one, bad run of luck, for example, and you're in big trouble, right? So keep that in mind. Also this week is MicroStrategy, MSTR, and they report on Thursday. They've had a pretty crazy run due to the rise of Bitcoin, because they've been investing a lot of their actual cash in Bitcoin, right? So they run pretty heavily the past few months. You can see that they ran from pretty much back in October, 160 a share. Let me draw a new line here, actually, one sec. So they're up from 160 up to 570. So they're up 260%, or sorry, 251% in about November, December, January, 3 months, right? Pretty crazy overall. But looking at the option chain here, we can see, one sec. So MSTR. You can see the IVs at around 112%. So right around the HV as well, right? Again, you want to be buying options usually when the IV is below the HV, typically, and you want to be selling options or using spreads when it's above the HV, right? Because premiums are very high. So looking at the month ahead, actually, I guess they don't trade weekly OPEX due to low liquidity, right? But you can see that right now, 570 or so. The expected move for the next month in either direction until February 19th is roughly $140 in one direction from the current price. So upside is like 710, for example. Downside is like 430. But again, a lot of this will have to do with the price of Bitcoin, actually, and not so much with earnings, right? Not much you can really do here option wise, because again, liquidity is pretty terrible. No open interest, no volume at all. Spreads are massive. You can see the spreads are massive here. So for example, over here, the bid is 76, ask 84. You can't trade these contracts, right? Because you're going to be paying perhaps $82 to buy the contract. If you go to sell it, even on a favorable move, you might have to sell it for example, $70, $78 or $79, right? You're going to lose money on that trade, right? So one key tenet of trading options is to focus on open interest and liquidity, and you want to be trading highly liquid assets, which is why trading the bigger names like Apple, Microsoft, Salesforce, for example, is more prudent because they have more volume on their shares traded each day, which correlates to higher volume in the option chain, and obviously higher open interest as well, right? So not much you can do with MSTR. But that being said, their compatriots, Riot and Mara, right? So Riot pulled back heavily last week. You can see over here on the chart, they had a nice big run to about $30, pulled back down to 20 or so temporarily. And the cash secured puts here are really juicy, actually. Super high IV and a lot of juice on the puts. And again, margin requirement isn't that high because it's a $20 stock roughly, right? So looking at Riot or Mara for Friday instead. Again, given that MSTR reports on Thursday after close, it's pretty risky to trade Riot or Mara into Friday OPEX because they may influence the price of Riot or Mara based on the MSTR move, right? So looking at the option chain anyway, just to look at it, right? So for Riot, for Friday's expiration, you're looking at roughly a expected move in the direction of $4 or so. So upside 25, downside 17. And then a potential move of around, let's see, a $1.40 addition. So 26.40 upside, 15.60 downside. But the cool thing about Riot, for example, is that the cash secured puts are so expensive, right? So you can get a lot of premium here. Like for example, for February 19th, if you were to sell the 15 strike on Riot, you're getting a $1.15, right? Your maximum risk here is 15 less a $1.15. So if you do 115 divided by 1385, you're returning 8.3% in about 4 weeks on Riot on cash secured puts. And if it stays above 15, you collect that premium. If it goes below 15, you're going to own Riot stock, 100 shares at an effective price of $14.86, right, roughly. So just a little idea there. Obviously, if you're trading, cryptocurrencies right now, a not so bad hedge is hedging your Bitcoin position, for example, using Riot options. For example, if you bought a put spread a month out on Riot, let's say you bought 20 bucks over here and sold the 15 strike here, you have about roughly 1-to-1 risk reward here. Again, not very favorable overall, but if you're concerned about a Bitcoin crash, and let's say you're holding a few Bitcoin and you want to hedge yourself, you can use put options here to hedge yourself using put spreads, right? Again, the asymmetry of risk isn't that great overall because the puts are very rich in premium. Obviously, people think it might come down in price, but it is a method you use to hedge yourself using if you're holding crypto, for example. And then there's also Mara as well, right, which I always mention each week too, right? So they're about 18 bucks, a little bit cheaper. You can see again that the out of the money cash secured puts here, like even at the 13 strike, are going for about $1.18, right? That's a lot of premium. Again, if you're to sell a cash secured put over here, for example, you're pulling in $1.17, right? Divided by risk of 13 minus 117 is $11.83. So divided by 11.83. So you're pulling in an effective return based on risk of 9.9% in about 4 weeks, which is pretty damn good, right? Again, you have to be okay with owning the stock at $11.83, right? That's the caveat. But otherwise, the expected move on Mara this week, if you are trading it, is pretty rich. Oh, sorry, that's for February. Never mind, one sec. For this coming week, it's still about $4 in one direction, right? So it's still about upside of 22, downside of 14. So keep that in mind as well. High volatility in Riot, Mara, and MSTR. Unfortunately for MSTR, they only offer monthly OPEX, so not much you can do over there. Also looking at, for example, GME, which has been a very, very hot stock this week, right? A lot of discussion around it, around a infinite gamma squeeze, which a lot of people are talking about and don't really know much about. I won't really delve into it too much because it is more complex. I have a video on this discussion on gamma flip. If you Google my videos on gamma flip, you can see it. It's from a few months ago. But anyways, GameStop is interesting just to watch it. I'm not trading it whatsoever myself. I don't really care to trade these kind of stocks because again, it's just too binary for my liking and too much risk. But if you're buying contracts here, if you're bullish, for example, and you're buying call options here, right? You're paying like $12 for at the money contracts that expire in 5 days, right? And the expected move on the stock by Friday right now, based on the current, well, you can't even see the higher strikes because they weren't even available as of Friday. But right now you can anticipate that it's about $20 in one direction. I'd imagine it'll move much more than that. So upside is around $80 this week. Downside is around $40. And then looking at the puts, you can see that they're about $1.80 or so. Actually, the risk reward on the puts might not be that bad overall. But again, I'm going to stay away from it regardless, just because it's just too binary for my liking, and it's too sporadic. If you are trading it, just remember that you should have a profit target at some point, because to think that it'll run to like $500 a share is kind of crazy. I have seen insane things happen in the market before, but I don't think it'll run to $500 a share, which some people are saying it's going to go to 420.69 as like a meme, for example. But I think you're going to see it pop up a bit higher, perhaps maybe touch 100, and then come right back down as fast as it went up. And I would just stay away from the stock overall if you're not already in it. If you're in it already, obviously hedge yourself. Take risk off the table by selling some of your shares and perhaps selling some covered calls if you want to sell some covered calls against your position. But again, I'm just saying to manage your risk very, very well. I don't really care, if it goes up or down, it doesn't matter to me whatsoever, right? Another one that's interesting is Palantir. Actually, for GameStop, we'll put up the chart just for fun too, right? Before we move on. So you can see the chart, how crazy it is. So here's GameStop's chart. Where is it? Here it is, GME. So you can see this massive short squeeze over here. It went from 20 bucks back on January 13th up to a high of 76 bucks on Friday, right? This is a pure short squeeze right here, right? So funds were shorting it below 20 bucks, and now they're being forced to buy back their positions because they're incurring massive losses. Again, depending on the fund, the loss may not be as big as you think it is. If it's a smaller fund and they're less than $1 billion, for example, it could be a massive loss, yes. But if they're a larger fund, $10-20 billion, it might be nominal overall, right? And it probably is. But either way, keep watching it for fun. It's a good learning experience on short squeezes right here because they aren't very frequent in terms of the magnitude overall. So it's kind of rare to see these massive squeezes on names that people are talking about, right? But moving on to the next name, which is Palantir, right? Palantir had a monster day on Friday, actually. And I'm happy about that. I had some call options on Friday and I sold them a bit too soon, but here's the 3-month chart. So you can see that, again, last week I mentioned they were consolidating in this pretty tight range between 2250 and 2750 roughly. And on Friday, of course, heavy volume candle, huge breakout to the upside, not too far from all-time highs at 3350 or so, right? And as you can see in the candle here, it finished close to the day high. This was nonstop buying all day. Like there were no pullbacks all day. It was buying incessantly all day, right? So pretty solid overall. I'm very bullish on Palantir. I believe in the company long-term. Peter Thiel, Alex Karp, both brilliant guys. And Thiel has a great track record. He built PayPal, and he's written actually a great book called 0 to 1. Definitely a great read if you want to read something interesting by Peter Thiel. Highly recommend it. But otherwise, looking at Palantir from a perspective of their event on Tuesday. So Tuesday, they actually have an event for demo day. I think it occurs at 4:30 p.m. Eastern time, if I'm not mistaken. And they're going to be demoing their offerings. So you may see some upgrades perhaps on Wednesday morning if they show something interesting. But it's possible that we saw a pop over here to a new range overall, and that we'll see a new range established between perhaps 30 or like 28 area as the downside, and upside could be around 35, maybe even 40 perhaps, right? But looking at the option chain, the IV inflated a lot on Friday, like massively, right? So here's the option chain on Palantir. One sec, PLTR. So you can see that the chain actually, the IV inflated by about 18% on Friday, and people are chasing calls all day. So they're buying out of the money calls all day long. You can see right now that the expected move for Friday is about, actually, I think Frank did it on the sheet. Let me just see. PLTR. Yep, he did. Thank you very much, Frank. Appreciate that again. So the expected move this week is 7.4% in other direction. So upside is roughly, where is it? It's like PLTR. Or sorry, it's 13.4%. So upside is 36.94. Downside is 28.22, right? And the potential move is 17.7%. So upside is 38.37 this week. So just near 40, and downside is around 27, right? So pretty wide range of values on Palantir this week. Again, here's a chart again, you can see. So a downside is around where it pushed above on Friday. Let me share my chart again here, right over here. And upside is way above the previous all-time high of 33.50, right? So you might see a push to 38 this week. It's possible, right? But again, it's also possible that we saw a pump up on Friday. Might see a second pump tomorrow as well, and it could be a small, by the rumor, still a news event, right? So it might come down after the event, even if it's a great event, right? So just keep that in mind if you're holding Palantir. I'm holding equity in it right now, and I plan on holding that longer term. But covered calls are very rich right now as well. So looking at strategies for the week ahead and the month ahead, actually. So if you're looking for this week, for example, right? Let's say you want to trade Palantir and you want to trade the upside. Again, you can trade spreads, and you want to trade spreads because the IV is very high. So you might want to do perhaps a at the money, for example, call option if you want to go long, and out of the money short on, for example, 38 strike short. In this case, you have a 5 wide call spread, 33 to 38, and you're risking $1.25 roughly to make a maximum profit of 375. So you have 3 times risk reward here. So every unit of risk you have 3 possible units of reward, which is phenomenal. And your break even is 34.25, right? Obviously, max profit would occur if it meets its potential move to the upside this week and closes above it on Friday, so above 38. If you want to trade the downside of it, obviously, I'm very bullish on Palantir, but at the same time, you got to be cautious and understand that these things do pull back and they can pull back as well. So you have to have an open mind as to where they can actually go. And so trading the downside, perhaps you might want to look at, for example, a 32, 28 put spread, for example. The risk reward isn't as great, so you're risking about $1.55 or so to make a maximum profit of 245. Not that exciting really overall. I prefer myself to instead sell cash secured puts out of the money. So for example, with IV inflating over here, you can get, again, at the 25 strike about $1 over here. If you want to sell at the money, a 30 strike, you can get almost $3 of premium here. That's almost, that's actually over 10% return over the course of a month if you do, if you don't get assigned, right? Or you own it pretty much where it was at open on Friday morning, roughly, right? So Palantir is a very, very interesting stock because they do have a lot of potential to the upside. I think they could push $50 this year, maybe even $60. And long term, I do believe they'll become kind of like a quasi Microsoft / Salesforce kind of company, right? So I think they're going to be a very, very strong stock to hold long term. I like trading it and owning it. So owning the stock itself plus trading the options too, right? That's why you want to build your core position and not touch it. Leave it there, set it, forget it. That's your long-term nest egg. And then trade opportunistically off support and resistance using spreads if IV is very high. And by doing that, you can, if you profit at all, take that profit and then buy more equity, right? It's not a bad idea. Alternatively, if you want to go synthetic longer term, right? If you want to buy an in the money call option, for example, long term, you can buy for example, 20 strike or even the 15 strike call options here for about $19.50 or so. So your break even is $34.50. So you're paying pretty much $2 of extrinsic value on the contracts, but you're paying almost what is it, about 2/3 the actual price of the stock, right? So it's equivalent to owning the stock itself. You're just paying a bit less for the actual stock itself, right? That's an idea you can have right there as well. And alternatively, if you were to, for example, buy the 15 strike and for 1 year out and sell the monthly OPEX out of the money, let's say you sold the 40 strike, for example, right here, right? You sold this one over here, your overall debit will be about $17.50 or so, which means that your break even would be 15 plus 17.50, which is 32.50, which is right where the current price is on the stock. And your upside for the next month would be up to 40, so you'd have upside of 750 overall on 1750 risk, so 750 over 1750. Your maximum upside for the month ahead would be 43% return, right? Not too shabby at all. I know discussing options, after you see some plays where you make 200%, 500%, 1,000% return, it isn't as exciting or sexy to make these smaller returns, comparatively. But keep in mind that the average person makes about 7% a year on their overall portfolio, investing in index ETFs, right? And also keep in mind that being consistent is more important than hitting home runs every day, right? Because hitting home runs is rare, and more often than not, you're going to strike out repeatedly before you hit one, so you may even break even on the long run, right? The whole idea is hitting base hits over time repeatedly, right? Be consistent, and you don't want to see a lot of deviation in your portfolio overall. Otherwise, I'll look at, I guess, one more name or so. Let me see what I was looking at on my watch list over here. One sec. Let me just pull it up so I can see what I was looking at. I think I was looking at Virgin Galactic. Well, yeah. Okay. 2 more names I'm going to look at, actually. I'm going to look at Virgin Galactic and actually 3 more names. Virgin Galactic, Jinko Solar Holdings as well, as per request of someone here as well. And also KO, Coca-Cola, right? So Virgin Galactic first and foremost. Where's the tick right there? There it is. New chart. Again, right? Nice move to the upside over here. And what you're seeing here is buying in anticipation of 2 events. One of them being the launch date for the test flight, and the second one being the anticipation of Kathy Wood, her new ARC-X ETF for space ETF, right? So she'll be buying this stock for sure when the ETF is available. As you can see, it's pushing not too far from the previous high, a 3-month high of 35.82. It's only about $1.30 away from that. And then after that, you have clear skies ahead to 42.49 all-time high back from February, right? So I do think that we can see a short squeeze on Virgin Galactic because it does have a lot of short interest as well here. You might see it push, 35, 37, 40-ish, and then burst to $50, right? That's what I think is going to happen with Virgin Galactic, obviously, just based on understanding the mechanics behind a short squeeze on it, right? But either way, let's analyze the option chain here, right? So looking at Virgin Galactic, we can see that the expected move for the week ahead is 9.1% in either direction, upside 37.41, downside 31.15. And the potential move this week is 12.2%, or upside of 38.47, downside of 30.09. Right, so looking at the option chain, again, I prefer to own this longer term than to just trade it. But I also do trade it as well because it does have a lot of IV in it and a lot of premium. So cash secured puts aren't a bad idea if you want to own it, again, longer term out of the money. Unfortunately, there's not much juice anymore around the 25 strike, so you need to go a bit higher now. And pretty much you might see a new range established in the chart between 35 and perhaps 50 now, instead of between around 18 and like 30, right, which is the previous range. So looking forward for the week ahead, we can see that the upside move might be best played if you, again, I don't advocate trading weeklies because they are risky, but there is some interesting risk reward to be had here. So for example, if you do believe that we're going to see an upside move this week, you might be inclined to do something like, for example, the, let me see, 38, this liquidity, these are pretty tight over here, okay? So you have a risk of about 95 cents over here to make a maximum of $4.05, right? So again, you have 4-to-1 risk reward. Break even is 35.95. Not a bad play on the call side. And then on the put side, again, you can do the same thing pretty much, but there isn't a lot of premium out of the money. So it won't be as favorable asymmetrically in terms of risk, right? Yeah, I prefer cash secured puts on Virgin Galactic than just trading put spreads here. I don't think it's a very good idea overall. That's my own opinion, guys. Obviously, do your own research. If you have a different opinion, that's your choice. I respect that, obviously, right? That's part of the beauty of the market, right? Is I'm bullish, you're bearish. One of us will be right at some point. And the last one, as I mentioned, was Coca-Cola, right? So obviously kind of an off the cuff, or not off the cuff, but kind of a random choice, given that no one really talks about it at all. But looking at Coca-Cola, I'm gonna pull up the chart so you guys can see what I see, right? 1 second. So here is the chart, right? And what I am seeing here is I'm seeing higher lows all year long, right? And higher highs. We have now seen a nice pullback on KO's chart over the last roughly since it was at $55 almost on December 31st. Since then, it's fallen down to 48 and change. I do expect a recovery over the next couple of months to around this area of 52-ish, right? This right here was precipitated by a downgrade by RBC on Coca-Cola. So again, I don't hold much weight there at all in terms of a downgrade. I do think you see an upswing back up to around 52-ish in the next couple of months. And also if the market does pull back, the broad market, that being, KO is actually a safe haven stock, right? So you may see people actually plow into the stock even on a market pullback. So that's why I kind of like it right now as well. IV's a bit high, but overall IV on KO is relatively low, so to speak. So if looking at KO, for example, right? You can see that IV is 24%. Historically, it's about 19%. So it's a little bit high, higher than normal on KO. But that being said, looking at about a month out or so, if you were to do, for example, the 50 call to 52.50 perhaps, right? Again, it's a pretty tight spread, but you're risking about 64 cents to make a maximum profit of $1.86. So again, 3-to-1 risk reward, break even is 50.64. You have 2 months till expiration for that to occur. Or you can go a bit wider if you want and have more profit range to adjust as well. If you go, 40, 55, for example, right? So, 50, 55, you're risking about 87 cents to make a maximum profit of 413, right? So again, still 4-to-1 risk reward over here, and break even would be $50.87, right? Not too bad, and you have 2 months expiration. So just an idea that I saw this week and I thought it was pretty interesting overall. Obviously, do your own research, manage your risk wisely. Don't take what I say, as gospel. I'm just the person that's analyzing the market and giving you guys my opinion, and I am wrong often as well. So keep that in mind, right? Otherwise, cash secured puts, not really much here to grab on premium cash secured puts wise. So I wouldn't say much about that. And lastly, I guess we'll look at maybe SPY. One thing I wanted to mention is that we're very overextended across the major indices right now. And I do think we're going to see a pullback at some point in the next month and a half or so. So what I noticed and what I'm seeing over the past year is that, we have these nice big runs and they're followed by a nice big pullback, right? So we run for a bit, we pull back, we run for a bit, we pull back. We had a nice run over here, right? And then a nice big short pullback over here, right? A little bit of run right there, and then a second pullback. But right now we haven't had a pullback basically since October 30th. So that's going on now about 3 months in a row. Oh, sorry, my bad, guys. Sorry, my bad. There you go, guys. Yeah. So, yeah, as I was saying was that over the past year or so, you can see that we pretty much moved from the bottom back in March to where we are right now, and that hasn't been without a few pullbacks along the way, though, right? So we saw a nice big rally over here from the March lows into June. And then a pretty decent pullback of about 8.5%, right? Followed by a resumption of the rally of about 9%, and then followed by a pullback of 7.5%, up again by 4% or so, and down again by 7.5%. And what happened to my screen? One sec. Remember that? Yeah. So one sec. There we go. So right now, we've had a rally pretty much since October from here to where we are right now of about 18.5%, right? We've had no pullbacks of substance whatsoever, right? And I'm inclined to think that we're going to see a pullback in the matter of about 10% or so, which will pull us back down to around the 350 area, test this line right here, and then resume back in the uptrend, right? I think the longer we go without a small correction to the downside, the more risky it is to trade on the long end of the market, right? That's just my opinion right there, obviously. So what I was looking at actually with a few of my students this week was looking at the put combo on SPY. So let me pull it up one sec. The options chain, where is it? SPY. Oh, there it is. Okay. So what we were looking at, and I was explaining to them how combos work, but I was looking at the March expiration, so March 19th expiration. And I was looking at, so my target was 350 downside. So I said, okay, you know what? What if I were to buy the put option itself? Well, that's pretty rich, right? Because if I'm betting on downside of 350, I'm paying about 10 bucks in premium right here. My upside would then be about 20 bucks, risking 10 bucks. So 2-to-1 risk reward. I'm not very in favor of that overall, right? So what if I were to instead do a 10-wide put spread overall here, right? I could then pretty much sell the 370 instead. Now my debit goes down to about $2.80 risk to make a maximum profit of $7.20, right? And if I go one further and I go out of the money, right? If I go right down to my target price of 350 or so, I could sell the 350 put over here, and I could buy the 340 put over here, thus creating a combo spread where I'm combining a debit spread and a credit spread. Now my risk goes down to about $1.70 or so, and upside is $8.30. Right? So my upside is 8.3 divided by 1.7. I have 4.88 times my reward per unit of risk, and my break even on the trade is only 380 minus 170. So my break even is 378.30, right? So very, very reasonable break even of about 1% from the current price, right? And basically, if I'm wrong, I'm going to lose almost nothing. If I'm correct, and we do get a pullback down, by March in the next month and a half or so, right? I have a nice big upside on this position. And so, for example, portfolio management, right? If you're managing your risk well, and let's say you're long, with let's say 10% of your portfolio in options that are long, right? And you allocate, for example, 1% or 2% of your portfolio into a hedge trade, kind of like this. Well, if you're correct and the market does come down and you hit max profit on your hedge trade of 2% risk, right? And you make 5x return, you're making 10% on your portfolio. So even if you were to lose 10% on your long positions, right, which won't happen. I mean, you won't lose your entire 10% if you're long, longer term, right? You might lose maybe 5% or 6%, but the whole idea is that you're going to offset your risk in the event of a major market crash, right? So that's just a little bit of food for thought. Obviously, I analyzed it this morning. I thought it was interesting, so I thought I'd share it with you guys. But that'll cap off our discussion for today, I guess. I'll cut the recording here, and we can do some Q&A if you guys want. If you enjoy the video, like it, subscribe it, hit a comment for me if you don't mind as well. And if you have any questions at all as well, put them in the comments. But otherwise, we'll do some Q&A right now, guys. So I'm going to stop the recording, and we can do